Today we consider how increasingly it seems that gold offers us the only plausible means of escaping from outright economic depression. So let's dive on in. Now, this channel provides global macro insights and champions the importance of sound money in a world gone crazy, so please do consider subscribing. Crush the economy or crush the currency. That is the very real prospect facing many Western central banks and governments. Indeed, the US has recently been exhibiting similar macroeconomic warning signs typically seen within emerging markets: a falling currency and rising bond yields, reflecting the prospect of a balance of payments crisis. Indeed, demand for the dollar has fallen at a time where the Fed has driven enormous liquidity into the marketplace. Moreover, as US Treasuries have sold off, yields, the risk premium held on lending to the US government, have risen. For ease of understanding, just imagine a $100 Treasury bill purchase offering a 1% yield, a $1 return. Consider a massive sell-off where investors question the solvency of the nation. That is, the ability of the government to actually pay their dues. Treasury demand collapses and your Treasury bill will now resell for just $50. But it still offers a $1 yield. That yield has doubled to a 2% return. So there's an inverse relationship between Treasury bills or bond prices and their yields. And so in getting us out of this economic catastrophe, what's the dream scenario for our central planners? Well, it would appear to be an inflationary recovery that is a massive stimulus to generate a centrally led green recovery while punishing savers through high inflation. Yet crucially, it will reduce the real value of the debt burden, the inflation tax. Ultimately, this would result in highly negative real interest rates, that is, inflation-adjusted interest rates. As real rates plunge, gold and silver prices will typically surge. This is the bull case for gold and silver. And so in saying crush the economy or crush the currency, let's explore option one, crush the economy. With the prospect of enormous stimulus under the new Biden administration, bonds have come under pressure in recent weeks, and this has seen yields rise. This has led to a rise in real rates of interest, which typically negatively correlate with gold prices. So as the real interest rate rises, the gold price can soften. This generally makes sense that gold yields no return. Under this option, no further stimulus can be provided by the government or the central bank for fear of crushing the dollar. But the economic damage of doing so, or of not doing so, would be catastrophic and cause a massive deflationary depression. Without the Fed intervening, bond yields would continue to rise until eventually a critical inflection point occurs. This is where the market's confidence in the solvency of the nation would completely falter. Meanwhile, investors would understand that the Fed no longer backstops their stock positions. And so this is deeply unpalatable and would completely undermine any confidence in central authorities, much to their longer-term detriment. And so the second and far more plausible scenario is that the dollar is likely to get crushed. And I don't doubt for a moment that there is every chance we may see a colossal dollar spike should there be another massive drawdown in the markets. And so crushing the currency ultimately involves direct debt monetization. Yes, we've already been engaging in this, but now we are talking about the need to start generating a significant reflationary impetus after the wealth generating capacity of our economies has been decimated. This will require enormous stimulus, the likes of which we have never really seen previously. And crucially, it must see the velocity of money work in unison with the money supply. Clearly, as this excellent chart from Michael Lebowitz illustrates, this is yet to actually happen. And so the Treasury and the Fed will need to work in unison to provide UBI, MMT for all of their desired social causes, as well as massive green infrastructure programs. This will require vast issuance of bonds, and projections for the 2021 US fiscal deficit are grim, as Lawrence Leopard makes clear in this tweet, where there is the very real potential of the deficit reaching as high as $8.2 trillion, a staggering sum, around 38% of US GDP in just 1 year. And so by the end of 2021, this would take us up to around $36 trillion of national debt without adding any interest burden. That's around 170% of GDP at current levels, plus the interest cost. And yes, we can expect some recovery to take place between now and year end, but regardless, we're talking about levels that are simply unpayable here. And so it would seem plausible that Treasury bills would come under increasing pressure in this environment, and thus yields would rise. And this would therefore require the Fed to intervene to buy up all new debt issuance, and thus engage in yield curve control, where they target a level above which they will not let Treasury yields rise above. And so we're told that deficits don't matter by the likes of Stephanie Kelton. Well, I think 2021 is the year where we really find out whether this is truly the case. And yes, Japan's national debt is far higher, but there's three distinguishing points worth noting here. First, that Japan is a creditor nation running a persistent current account surplus. It is not reliant upon the kindness of strangers. Second, that many Japanese have perceived holding bonds as something akin to a national duty. And third, that they were never the world's largest economy and couldn't act as a comparable deadweight to the global economy. And so why do I and numerous others see gold as the only way out? Well, let's consider the Treasury gold reserves and assume that they're all there. A big assumption perhaps, and a video for another time. But the accounts state a total held of 261.498 million. If the US were to revalue gold at $20,000, this would revalue these reserves to $5.23 trillion. This money could be marked up in the Treasury General account, according to a recent op-ed by Kevin Walsh, and spent into the real economy. According to the Fed, the Keynesian fiscal multiplier is 1.5. Now, this simply means that for every $100 that's injected into the economy by the government, it generates $150 of additional income generating activities. While it's highly debatable as to whether it still remains above 1, let's take the Fed statistic on the multiplier there. So a $5 trillion stimulus, courtesy of the gold revaluation, could generate an additional $7.5 trillion on US GDP. If this was conducted today, debt's GDP would fall below 100%. This would generate their much needed inflation, but it also raises the argument of how high the gold number will need to go as the deficit and the debt would continue to grow. And crucially, this can only be done with gold, given that governments and central banks largely do not hold any other alternatives. And yes, silver as an inflation hedge and monetary metal would do handsomely. And we have seen similar proposals previously with the likes of a $1 trillion coin. Equally, this approach could take place at Bretton Woods 2.0, but such a devaluation of all fiat currencies simultaneously is deeply unpalatable, and so central banks will try to extend the old and accelerate the new with their CBDCs and now apparently perpetual bonds, perpetual debt, and more like perpetual zombification of already zombified debt-ridden countries. Yet, as we discussed before, China may force the West's hand. What do you think? Do let me know in the comments below. Please consider signing up for my free monthly newsletter if you haven't done so already, and I look forward to seeing you next time. Thanks for joining me. Bye bye.